Assalamu Alaikum everyone, welcome back to another video. I hope you're having a wonderful day. So as usual, we are looking at 5 different companies that are undervalued at the moment that we could potentially be looking at for our portfolios for the month of June. Slightly later than I planned. I was away last week. I went to Greece for a week. I think I mentioned it in the last video. It was really good. I'm just exhausted right now. I just came back last night, but alhamdulillah, all good. It was really good holiday. So yeah, I like to do a little bit of traveling here and there. So in today's video, we would like to look at 5 different companies that are undervalued at the moment. As always, don't take this as financial advice, please. Do your research. These are great companies in my opinion that seem undervalued at the moment. Do your research. Always add margin of safety based on everything we're going to talk about today. On a side note, completely different to what we're talking about here, to kind of think about the bigger picture. This time last year, I was getting ready to do Hajj, and subhanallah, I see basically a lot of people now going to Mecca, and it's just kind of made me a little bit jealous, and just like thinking back and how amazing it was. If you have not done Hajj and you are capable of doing it, do not delay it. Wallahi al-Azim, do not delay it. You never know. Just go and do it if you can. And now these days is ridiculously expensive, depending where you're coming from and so on. But yeah, I hope you get to do it. If you've done it before, mashallah, alhamdulillah, that's absolutely wonderful. I would love to go back again, inshallah, soon. So yeah, and I was just watching, basically on YouTube, all these people coming from different countries and going to Mecca and so on, and it looks so amazing and so hot at the same time. But alhamdulillah, it's a blessing from Allah subhanahu wa ta'ala. If you get the chance, please do it. Now let's just talk about the general markets. As you can see, the portfolio is now going back to where it was a few weeks ago, and basically almost £105,000. I think it was £106,000, the highest it's been in the last 2 months. So what I want to do today is I want to talk about these 5 companies. But before we do that, as always, genuinely, it takes so much effort to put these videos together and to share it with you guys. So I would genuinely appreciate if you can just press that like button. First of all, that's all I need you to do first of all. Secondly, if you have not subscribed, come on, what are you waiting for? And thirdly, if you've got the chance, and if you're capable, please join us to the Patreon account where you get access to all my buys and sales. You see everything that I'm doing and sharing with the community, and also the community who are sharing really genuinely wonderful ideas, and they're sharing their stocks that they buy and what they're selling and so on. You might get some ideas of basic stocks to buy and so on, so why you should buy, why you should not buy. So there's a lot of brothers who are actually sharing good practices. So it would be absolutely amazing if you can join us on the Patreon account, which then gives you access to the Discord, inshallah. Now let's talk about general markets. So for this month, as you can see, a month to date, the S&P 500 is just over 3% up. Dow Jones is actually down. Nasdaq is about 5%, and FTSE 100. I bet you that's a lot to do with Nvidia, and the FTSE 100 is just 1.3% down. So nothing major to really talk about. So everything is going okay. When you look at the last 6 months, everything is up basically. Even the FTSE 100 is up over 9%, which is quite nice. So overall, basically we need a little bit more than basically what we've seen, the down days that we've seen the last few weeks. We need a little bit more of that in the basically coming months, especially basically July and August. September is a crazy month where the stocks tank almost a 4, 5, 6%. I've seen that in the last 5 years, so that could potentially happen. But right now we're just going to focus on the now, and of course buy high quality businesses, and that's exactly what we're going to look at today. All I'm going to do now is just kind of give you some ideas of some stocks that I think are undervalued at the moment, but please do your own research as always. And as you can see on the top here, we have the same basically matrix that we normally look for. So let's get started. I don't want to make the video any longer than it needs to be. And the first company that we're looking at today is Accenture. Accenture is one of those companies that have been around for a very, very long time, and it's basically a consulting business. So they go to other businesses, they talk to them about how they use ICT or IT side of things, and they help those companies to actually become more efficient so they can generate more profits and so on. So it's a really interesting business. And before we just move on to the company, I just wanted to show you basically what Morningstar said about this business. So they said a wide mode behemoth IT service, and they talked about the fact that it's the largest IT service companies basically in the world, providing both consulting and outsourcing capabilities. And they say the growth will remain healthy, basically healthy and gradual pace, thanks to the basic persistence of digital transformation trends. And that's really important. There's a lot of this happening right now as we speak, and this is probably one of the companies out there that a lot of businesses will go to and say, okay, how do we utilize this? How can we actually use this efficiently? And of course, Accenture basically will maintain its wide economic mode, which is quite important. Now, it has a market cap of $189 billion, wide economic mode, $288 per share, dividend yield 1.7%. Now, I think that's one of the highest I've seen for this company. Okay, in the last 5 years, it's been 1.46, and right now it's 1.79. So just based on the dividend theory method, you could see it actually seems undervalued at the moment. And when it comes to PE, the 5-year average is 26.6. Okay, and right now it's about 23, so it's actually cheaper than where it has been. Now, of course, you're gonna have to do a little bit more research to find out exactly why that's happening and so on, but the payout ratio right now for that dividend is 42%, which is fine. Latest increase was 15%, and the 5-year growth rate of 11%, which is really good. And in terms of dividend streaks, 18 years of doing that. Another 7 years or so, this company will become a dividend aristocrat. Annual payout right now is looking $5.16, safety 92%, and the 5-year growth rate when it comes to revenue side of things is 9%, and when it comes to the EPS is about 10%, profit margin about 11%, return on equity 27%, and return on invested capital of 32%, which is absolutely huge. Free cash flow $8.7 billion, total return the last 10 years 15%, growth estimate next year 8% after that, fairly valued right now, $292 per share is where they think the price should be. It's not far off from there right now. Right, so next company that we're going to look at today is Lululemon. This is one of the companies that have actually tanked so much in the last few months. In fact, let's just have a quick look, because I think it's down 30%, if not more, year to date. It's 37% down year to date. So at one point, the stock was $478 per share, and right now we're looking at $317 per share. So let's have a look at it a little bit more detailed. So it's got basically almost a 40 billion market cap. It has a narrow economic moat. I actually think this is probably one of the major problems for this company. Although they sell products that they're not unique. I mean, Nike, based on Nike, has got similar sort of products. There are other companies that have a similar product. Anyone can get into this market if you like. So I do actually believe that rating is absolutely correct. Price right now $317 per share. When it comes to dividend, they don't pay any dividends, and the 5-year growth rate in terms of revenue side of it 20%. This is the reason why people absolutely love this company. Look at this EPS and look at this last 5 years. So 20% and 24%. Profit margin 16%, 41% in terms of return on equity, and 40% when it comes to return on invested capital. So it is really a good investment, but you just need to buy at the right time with it especially, and also be careful basically moving forward, because if there are other competitors out there with a similar sort of products that can sell it for cheaper, because I think their products is about $100 basically dollars or more or less. I've never bought anything from them, to be honest with you. So free cash flow right now is $1.7 billion, which is decent, and total return in the last 10 years 22%, which is really good. That's that's a high growth business. That's what you would expect basically from software companies, from those high tech companies. Growth estimate for the next year 11%, then 12% after that. Fairly valued right now, $285 per share. Now if we go back here, let's see what basically Wall Street is saying. 19 strong buys, 5 buys, 8 holds, 1 sell, and 2 strong sells. And their price target is 27% from where we are right now, $405 per share. They're definitely bullish on this. Let me just look at the earnings expectations movement. So double digits every single year, but nothing huge again. So again, double digits when it comes to that. Now, in terms of forward PE, what is the forward PE? 22. So that's not really bad. I mean, where it is now, it seems really interesting business. Now, in terms of the stocks, but where it's trading, the metrics actually are quite good right now. Especially, let me have a quick look in the balance sheet and the revenue side of things. Right, so you can see the revenue is actually growing massive. So from $1.7 billion to right now $9.8 billion. That's massive growth. So this is probably why this company has been trading so expensively in the last few years, basically. And look at the gross profit, by the way. Basically, they made for about let's call it $10 billion, and then $5.7 billion of that became gross profit. Of course, after the taxes and all of that stuff, then of course that's gonna, the net income will be interesting to see. The net income $1.5 billion. So nothing, it's not huge, but again, from 10 billion and saving about $1.5 billion, basically, it's not bad at all. It's very interesting business, but I would be careful with the actual business model and barriers to entry and so on. Next one is J&J, $354 per share. Wide economic more, $147 per share right now. Dividend yield right now is standing at 3.4%, which is really good. Payout ratio only 46%. This is one of the best pharmaceutical companies out there, and it's been there for a very long time. This has higher basic credit rating than the United States of basic government, which is absolutely crazy. The latest increase was 4.2%. The 5-year growth rate was 6%. 61 years of increasing that dividend, almost $5 for every share of this business that you own. Safety 99%. Growth estimate in the basically the 5-year revenue side of things, we're looking about the compound annual growth rate of 3%. EPS about 6%, profit margin about 20%, return on equity 23%, return on invested capital 22%, which is one of the reasons why I really like this business and own it. $18.2 billion of free cash flow right now. Total return the last 10 years, we're looking about 6%. Growth estimate next year about 3%. Growth estimate after that is 5% for every single year. And this is what I expect from this business, 5% to 10% every single year, especially now they've sold the consumer section. The pharma bit, okay, I'm expecting this sort of rate, if not higher. 10% discount right now, $164 per share is where they think the price should be. Now, let's have a quick look of J&J in terms of earnings expectations moving forward. Okay, so 6%, almost 7% this year, 3%, 4%, 2% after that. 3% in terms of revenue, 4%, 2%. So nothing huge to basically worry about. And in terms of ratings, 7 strong buys, 5 buys, 11 holds, which is quite interesting. And then 16% basically upside from where we are right now. So $171 per share is where they think. But this is based on Morningstar, which is slightly bit more. I would say this company gives you a little bit more margin of safety, but also give yourself a margin of safety as well. The next one is UPS, another one that I own, $118 billion market cap right now. Wide economic more, $137 per share. Dividend is now going up to almost 5%, which is absolutely crazy. 4.7% right now. Payout ratio 81%, very, very high, but I think that will come down soon. Latest increase was just 1%. I think they just did that just to keep it going. And the 5-year growth rate basically is about 12% right now. Dividend streak of 14 basically years. Annual payout $6.52. 70 and so almost 70% safety when it comes to the safety side of things. And then the 5-year revenue growth annual compound annual growth rate is right now 5%. 7% when it comes to EPS. Profit margin about almost to 6.6%. Return on equity 32%, return on invested capital of 20%, and free cash flow right now $5.6 billion, 6% growth in the last 10 years. So total return in the last 10 years is 6%. Growth estimate next year 20%, 7% after that. Morningstar is saying it's about 13% discount right now. $158 per share is where the price is now. Just to quickly have a look at UPS again, this company I do own it and I'll show you in a second. But when we look at the Morningstar, Seeking Alpha valuations, analyst valuations, so strong buy is about 13, 1 buy, 15 hold, 1 sell and 1 strong sell, and that's about 18% upside from where we are right now. Now in terms of EPS, okay, right now this is a decline. That's the reason why the stock's down. But then after that, 8 double digits every single year for the following years, and almost 2%, 5%, 4%, which is what I expect from this company moving forward in terms of in terms of revenue side of things. Final one is Nike, $146 billion market cap. Wide economic more, $96 per share right now. Dividend yield of 1.53. Now this is one of the companies that have been undervalued for quite some time. I'm not sure exactly what is happening with the business, but I'm sure this company will bounce back. I mean, into at least 150, 120. I think it was 130, maybe it's 5 to 40 during COVID time. So it will be interesting to see if it ever gets back to those valuations. Payout ratio right now 39%. Latest increase was 8.8%. 5 years of growth rate basically was about 11%. Dividend streak of 21 years, so 4 more years and it will become a dividend aristocrat. Annual payout we're looking at $1.48. Safety 99%. Last 5 years, painting the revenue side of things grew about 8%, EPS about 15%, which is absolutely huge. Profit margin 10%, 36% when it comes to return on equity. Return on invested capital 21%, $6 billion of free cash flow right now. Total in the last 10 years, total return is about 11%. 5% growth expected for this year, 13% after that for every single year for the following 5 years. 25% discounted, $129 per share is basically where they think the price should be. This is really a high quality business, and I'm not sure where the major issue is. I don't know. Let me just have a quick look expected, because I sold it, my shares, because I had better options. There was nothing wrong with the business, but I felt like there was better options out there. So this year they're expecting the earnings to grow about 15%, which is absolutely amazing. Then about 6-8% after that, 12% after that. So if we just focus on the first three, as you can see, 15%, 7%, 12, 13% almost, which is really good. Now looking at the revenue side of things, maybe this is why. So this year they're expecting absolutely to be flat. Following years about 1.2%, 6% after that, 5% after that, and so on. So that's probably why. That's why maybe they came out and said, you know what, we don't expect much when it comes to revenue side of things. But just think about this, okay? Let's have a look at the balance sheet for this company, where it's been. So $27.7 billion in 2014 to right now $51 billion. That's absolutely huge growth. Check this out, 27 to right now $51 billion. That's a really good company. Of 22 billion of that, 22.8 of that actually became gross profit. Now net income after all of that, we paid taxes on all of those things, net income about 5 point. Yeah, these are the things why I don't like this type of businesses, where they have so much in basically inventories and all of these things. And look at that, basically gross profit was $22.8 billion, and we just taken home about $5 billion of that, which is absolutely crazy. But let's click the ratings and see what the company is saying. 17%, 7%, 10 holds, 1 sell, and 2 strong sells. Now 15% upside from where we are. Let's just get the headlines from these people. So just have a look at, okay, so you can pause the video and see basically what people are saying about the company. By the way, some of these things were the ratings were done quite a long time ago. I just sometimes go through quickly to see what people are saying about the company, but overall it is a really high quality business. But right now it seems they can't get out of the block. Anyway, there you go. That's when it comes to Sharia compliant, that's basically where we are right now. Just pause the video, have a look at that. As always, please don't take this as a financial advice. Always do your own research. So I'm going to quickly show you the ones that I own in my portfolio. So I do own J&J. I'm down about 4%. I do own a UPS, okay, and I think that's it. That's the only two that I own in this in my portfolio anyway. So I just want to let you know that, just to be on transparent. Anyway, have a wonderful day. Assalamu Alaikum.